Hello and welcome. In this course, we will explore inventories based on International Accounting Standard 2. The accounting standard known as IAS 2, which deals with inventories, was officially adopted by the International Accounting Standards Board in April 2001. However, its origins go back even further, as it was first introduced by the International Accounting Standards Committee in 1993. This standard replaced an earlier version that focused on how inventories were valued and presented under the historical cost system, which had been in place since 1975. Later, in December 2003, the standard was revised as part of a broader effort to update key technical areas. This revision also brought together existing guidance from a related interpretation, ensuring more consistent use of inventory costing methods across different situations. Over time, several updates have been made to the inventory standard through changes introduced by other accounting standards. These adjustments were relatively minor but necessary to keep IAS 2 aligned with evolving financial reporting practices. Updates came alongside new standards dealing with topics like fair value measurement, financial instruments, revenue recognition, and lease accounting. Each of these changes helped ensure that the guidance on inventories remained consistent with the broader framework of international financial reporting. The standard on inventories provides a complete set of guidelines that are designed to be understood as a whole. While it follows the original structure used when it was first adopted, all parts of the standard carry the same level of importance. To fully grasp and apply its requirements, it should be considered together with its stated objective, the overall principles outlined in the IFRS framework, and the general guidance provided in the preface to the standards. When specific guidance is not available within the inventory standard itself, the principles found in the standard on accounting policies and changes in estimates can help determine the appropriate approach. The main goal of this standard is to provide clear guidance on how inventories should be accounted for. It explains how to determine the cost of inventories, how that cost should be recognized as an expense, and how to identify when inventories may need to be written down to reflect a lower value. By doing so, the standard ensures that financial statements present inventories in a consistent and reliable way, helping users of those statements better understand a company's operations and financial position. This standard applies to most types of inventories across various industries. However, there are a few exceptions. It does not cover financial instruments or biological assets that are linked to agricultural activities, including produce at the time of harvest. Additionally, it does not apply to inventories held by producers of agricultural or forest products or to minerals and similar items when these are measured at net realizable value based on long-standing industry practices. In such cases, any changes in value are reflected in the profit or loss for the period in which they occur. The standard also excludes inventories held by commodity broker traders when they are measured at fair value minus the cost to sell, with any changes in that value also recognized in the same period. Some types of inventories, such as harvested crops or extracted minerals, are measured at their net realizable value during specific stages of production. This usually happens when the sale of these items is already secured through a forward contract, a government guarantee, or when they are traded in an active market with very little risk of not being sold. In these cases, only the measurement part of the inventory standard does not apply. The same goes for inventories held by broker traders who buy and sell commodities either for clients or for themselves. These inventories are typically intended for quick resale, taking advantage of price changes or trading margins. When broker traders use fair value less cost to sell, they are also excluded only from the measurement rules of the standard. In the context of this standard, inventories are defined as assets that a business holds for specific purposes. These include items that are intended to be sold during the normal course of business, goods that are currently being produced for future sale, and materials or supplies that will be used in the production of goods or in the delivery of services. This definition helps clarify what types of assets fall under the scope of inventory accounting and ensures a consistent understanding across different industries. Net realizable value represents the amount a company expects to receive from selling its inventory in the normal course of business, after accounting for any additional costs needed to complete the product and make the sale. On the other hand, fair value is the price that would be received to sell an asset in a well-organized transaction between market participants on a specific date. While both terms involve the idea of estimating value, they are not the same. Net realizable value is specific to the business itself and reflects what the company expects to gain. Fair value, however, is more general and market-based. Because of this, the net realizable value of inventories may not always match their fair value after deducting selling costs. Inventories include a wide range of goods that a business holds for resale. This can be items like merchandise purchased by a retailer or even land and other property intended to be sold. Inventories also cover goods that have already been produced, those still in the production process, and materials or supplies waiting to be used in that process. In some cases, a company may incur costs to fulfill a contract with a customer. If those costs don't result in inventories or assets covered by another accounting standard, they are treated according to the rules for revenue from contracts with customers. Inventories should be valued at whichever is lower between their cost and their net realizable value. When calculating the cost of inventories, all expenses directly related to purchasing the items, converting them into a saleable form, and any additional costs necessary to bring the inventories to their current location and condition must be included. This approach ensures that inventories are reported at a realistic value that reflects both their acquisition and preparation costs. The cost of purchasing inventories includes the purchase price itself, along with import duties and other taxes that the company cannot recover later from tax authorities. It also covers transport, handling, and any other costs directly related to acquiring finished goods, materials, or services. When calculating these costs, any trade discounts, rebates, or similar reductions are subtracted to arrive at the final purchase cost. The costs of converting inventories include all expenses directly linked to producing the goods, such as the wages of workers involved in the production process. They also cover a fair share of both fixed and variable production overheads. Fixed overheads are indirect costs that stay mostly the same no matter how much is produced, like depreciation, maintenance of factory buildings and equipment, and the salaries of factory management. Variable overheads, on the other hand, change in direct proportion to production volume, including costs like indirect materials and labor. Together, these costs reflect the total effort involved in turning raw materials into finished products. Fixed production overheads are allocated to the cost of conversion based on the normal capacity of the production facilities. Normal capacity refers to the average production expected over several periods under typical conditions, considering any planned maintenance downtime. If actual production closely matches this normal capacity, it may be used for allocation. Importantly, the fixed overhead assigned to each unit does not increase due to low production levels or idle equipment. Any overhead that cannot be allocated is recorded as an expense in the period it occurs. When production is unusually high, the fixed overhead allocated per unit is reduced to ensure inventories are not valued above cost. Variable production overheads, however, are assigned to units based on the actual use of production resources. Sometimes a production process creates more than one product at the same time, such as joint products or a main product alongside byproducts. When the costs to convert each product cannot be clearly separated, these costs are divided in a reasonable and consistent way. One common method is to allocate costs based on the relative sales value of each product, either when they become individually identifiable or when production is complete. Byproducts are usually small in value and are often measured at their net realizable value. This amount is then subtracted from the cost of the main product, ensuring that the value recorded for the main product remains close to its actual cost. Other costs are included in the cost of inventories only when they help bring the inventory to its current location and condition. For example, this might include certain overhead costs that are not directly related to production or the expenses involved in designing products tailored for specific customers. These costs are added to ensure the inventory's value reflects all necessary expenses up to the point it is ready for sale or use. Certain costs are not included in the cost of inventories and are instead recorded as expenses when they occur. These include abnormal waste of materials, labor, or other production costs, as well as storage costs that are not essential to the production process before the next stage. Additionally, administrative overheads that do not help bring the inventories to their current condition or location are excluded. Finally, costs related to selling the inventory are also recognized as expenses rather than being added to inventory value. Borrowing costs are generally not included in the cost of inventories except in specific situations. For instance, if an entity buys inventories with deferred payment terms that include a financing component, the interest portion of that financing is recognized as an expense over the period of the financing. This means that the extra amount paid due to delayed payment is treated separately as interest, rather than being added to the inventory cost. When agricultural produce is harvested from biological assets, its initial cost is measured based on its fair value minus any cost to sell at the moment of harvest. This value serves as the cost of the inventory from that point onward, following the principles outlined in the relevant accounting standards. Various techniques can be used to measure the cost of inventories, including methods like standard costing or the retail method. These approaches are acceptable when they provide results that closely approximate actual costs. Standard costing, for example, considers typical levels of materials, labor, efficiency, and capacity use. It is important that these standards are regularly reviewed and updated as needed to reflect current conditions accurately. In the retail industry, the retail method is commonly used to measure inventories, especially when there are large quantities of fast-moving items with similar profit margins. This method calculates the cost of inventory by applying a percentage gross margin to reduce the sales value. The percentage reflects adjustments for items that have been marked down below their original selling price. Typically, an average percentage is applied for each retail department to estimate inventory costs accurately. When inventories consist of items that are not usually interchangeable or goods and services made for specific projects, their costs are assigned using the specific identification method. This means each item's actual cost is tracked individually. This method works well for items set aside for a particular project, whether purchased or produced. However, for large quantities of interchangeable items, specific identification is not suitable, as selecting certain items to remain in inventory could be manipulated to affect profit or loss. For inventories not subject to specific identification, the cost should be assigned using either the first in, first out FIFO method or the weighted average cost formula. An entity must apply the same cost formula consistently to all inventories of a similar nature and use. However, different cost formulas may be appropriate for inventories that differ in nature or use. For instance, inventories used in one operating segment might serve a different purpose than similar inventories in another segment. Simply being in a different geographic location or subject to different tax rules does not by itself justify using different cost formulas. The FIFO method assumes that the earliest items purchased or produced are sold first, meaning the inventory remaining at the end of the period consists of the most recently acquired items. In contrast, the weighted average cost method calculates the cost of each item based on the average cost of similar items available at the beginning of the period combined with those purchased or produced during the period. This average can be calculated periodically or continuously with each new shipment, depending on the entity's circumstances. The cost of inventories may not be fully recoverable if the items are damaged, partially or completely obsolete, or if their selling prices have dropped. Additionally, if the estimated costs to complete or sell the inventory have risen, the recoverable amount may be lower than the cost. Writing down inventories to their net realizable value reflects the principle that assets should not be recorded at more than the amount expected to be realized from their sale or use. Inventories are generally written down to net realizable value on an item-by-item basis. However, in some cases, it may be appropriate to group similar or related items together. This is often the case for items within the same product line that share similar purposes or end uses, are produced and sold in the same geographic area, and cannot be practically evaluated separately. It is not appropriate to write down inventories based solely on broad classifications, such as all finished goods or all inventories within a particular operating segment. Estimates of net realizable value are based on the most reliable evidence available when the estimates are made. They reflect the amount the inventories are expected to realize, taking into account price or cost fluctuations that directly relate to events occurring after the reporting period, provided those events confirm conditions that existed at the period's end. Estimates of net realizable value also consider the purpose for which the inventory is held. For instance, the net realizable value of inventory held to fulfill firm sales or service contracts is based on the contract price. If the inventory quantity exceeds the amount required by these contracts, the net realizable value of the surplus is determined using general selling prices. Provisions may arise when firm sales contracts exceed available inventory or from firm purchase contracts, and these are accounted for according to IAS 37 provisions, contingent liabilities and contingent assets. Materials and other supplies held for use in production are not written down below cost if the finished products they will become are expected to sell at or above cost. However, if a decline in material prices suggests that the finished product's cost exceeds their net realizable value, then the materials are written down to net realizable value. In these cases, the replacement cost of the materials may be the most reliable measure of their net realizable value. A new assessment of net realizable value is made in each subsequent period. If the circumstances that previously led to writing down inventories below costs no longer exist, or if there is clear evidence of an increase in net realizable value due to changed economic conditions, the write-down is reversed. However, this reversal is limited to the original amount written down, so that the new carrying amount is the lower of the original cost and the revised net realizable value. For example, this can happen when an inventory item that was previously written down due to a drop in selling price is still held in a later period and its selling price has risen. Recognition as an expense. When inventories are sold, their carrying amount is recognized as an expense in the same period that the related revenue is recorded. Any write-downs of inventories to net realizable value, as well as losses of inventories, are also recognized as expenses in the period they occur. Conversely, if there is a reversal of a previous write-down due to an increase in net realizable value, this amount is recognized as a reduction of expenses in the period of the reversal. In some cases, inventories may be allocated to other asset accounts. For example, when inventory is used as a component in the construction of property, plant, or equipment. In such instances, the cost of these inventories is recognized as an expense over the useful life of the related asset. The financial statements shall disclose the accounting policies adopted in measuring inventories, including the cost formula used. They must also present the total carrying amount of inventories classified in a manner appropriate to the entity. Additionally, the carrying amount of inventories measured at fair value less cost to sell should be disclosed. Finally, the amount of inventories recognized as an expense during the period must be reported. The financial statements should also disclose the amount of any write-down of inventories recognized as an expense during the period, in accordance with paragraph 34. Additionally, they must report the amount of any reversal of write-downs that is recognized as a reduction in the expense for inventories in the period, also in line with paragraph 34. The circumstances or events that cause the reversal of such write-downs should be clearly explained. Finally, the carrying amount of inventories pledged as security for liabilities must be disclosed. Information about the carrying amounts of inventories in different classifications and the changes in these assets is valuable to users of financial statements. Common classifications include merchandise, production supplies, materials, work in progress, and finished goods. The amount of inventories recognized as an expense during the period, often called cost of sales, includes the costs that were previously part of the inventory measurement and have now been sold. It also includes unallocated production overheads and abnormal production costs. Depending on the entity's circumstances, other amounts like distribution costs may also be included. Some entities use a profit or loss format that discloses amounts differently than simply showing the cost of inventories recognized as an expense during the period. In this approach, expenses are analyzed based on their nature. The entity discloses the costs recognized as expenses for raw materials and consumables, labor costs, and other costs, along with the net change in inventories for the period. The effective date of this guidance is for annual periods beginning on or after January 1st, 2005. Earlier application is permitted and encouraged. Entities adopting the requirements earlier must disclose this fact and the impact of the change on their financial statements. IFRS 15 revenue from contracts with customers issued in May 2014 made amendments to paragraphs 2, 8, 29, and 37 and deleted paragraph 19. Entities are required to apply these amendments concurrently with the application of IFRS 15. Similarly, IFRS 9, issued in July 2014, amended paragraph 2 and deleted paragraphs 40A, 40B, and 40D, with entities applying these changes when adopting IFRS 9. Additionally, IFRS 16 leases, issued in January 2016, amended paragraph 12, and entities are to apply this amendment when they implement IFRS 16. This standard replaces the earlier IAS 2 inventories that was revised in 1993. It also supersedes SIC 1, which dealt with consistency in using different cost formulas for inventories. The amendments listed in this appendix are required to be applied for annual periods starting on or after January 1st, 2005. If an entity chooses to apply this standard for an earlier period, then these amendments must also be applied for that earlier period. The amendments included here, made when the standard was revised in 2003, have been integrated into the relevant pronouncements published within this volume. International Accounting Standard 2 Inventories, as revised in 2003, was approved for issue by the 14 members of the International Accounting Standards Board. The approval was signed by Sir David Tweedy, Chairman, Thomas E. Jones, Vice Chairman, and members Mary E. Barth, Hans-Georg Bruns, Anthony T. Cope, Robert P. Garnett, Gilbert Gellard, James J. Lysenring, Warren J. McGregor, Patricia L. O'Malley, Harry K. Schmid, John T. Smith, Jeffrey Whittington, and Tatsumi Yamada. Thank you for completing our course and for the attention and dedication you've shown throughout. We are happy to have contributed to your professional development and encourage you to help us improve by providing your feedback. If you have any questions or suggestions, feel free to reach out via email at info@qlever.al or through the contact forms on our website. Also, we invite you to follow us on social media and our YouTube channel to stay updated on upcoming training sessions. Thank you once again, and we look forward to seeing you in our future courses.